Okay, so just like I was saying, the phases that based on Wyckoff theorem, the market goes through the accumulation phase, right, where the price is oversold, and then price goes, because price is oversold, that means if there's value, right, there's more value in the stock or the instrument, and price is most likely going to go up. The composite man undergoes an accumulation phase, right, then marks up price. At some point, the market becomes overbought, which then price enters a distribution phase and then max price down. So the concept of Wyckoff is to take advantage of this big movement in price, where price is in, you can see that this is where there's the most push, right? He's trying to take advantage of this big push in price, right? Okay, now we'll go over and look at the schematics, the different schematics of Wyckoff. So we'll begin by looking at the Wyckoff accumulation schematics. It defines it in two ways. There are two basic schematics you can look out for, and we'll see how to break that down. Now we're going to look at the phase one, the accumulation schematics type 1, and I'll try and explain the different phases. Now, so here's what I need you to understand. Wyckoff, right? The concept of Wyckoff accumulation and schema and distribution is to help you understand something I like to call weak to strong hand transfer, right? So weak to strong hand transfer is a process where retail traders are shaking off the market, and then the composite man gathers their liquidity and push price up. Now, here's what I need you to understand about price. Now, imagine if you have all the money in the world, right? If you have all the money in the world, it doesn't make sense because, and you buy something and you're buying the market. Well, if you're the only one buying a stock, how do you make profits? You can't make profits unless there are other people selling, right? You can't make profit unless there are other people in the market. In the same way, right? The composite man doesn't make money unless they are retail traders or other hedge funds or other composite mans or smaller composite man, basically. So in essence, your stop losses, right? Your buy stop orders, your sell stop orders that are triggered and then run against you, those are profits taken. So for example, when you take profits, that's someone else's loss. And when you take losses, well, that's someone else's gain. The composite man is positioning himself to make the most gain in the market. And then by understanding Wyckoff schematic and Wyckoff methodology, you're giving yourself an understanding of what happens within the area where the composite man before the composite man makes the move. So for example, let's say price is coming down, right? So let's say the market is bearish. Now, if the market is, let's say this bearish market is about to change and continue to go bullish, or is even just going to continue going bearish, there will have to be you will usually see some sort of, ranging market or consolidation, and then price would go up. But within this consolidation, it might look something like this. So let's say price wants to go up. Price might first of all go down, then go up. Now, this movement here it basically explains Wyckoff. Now, what do you think happened here? In pushing itself, in price going down, it brought in a lot of retail traders to start thinking, oh, this market wants to go down, it wants to go down, and then they start selling. Now, when they start selling, where do they put their stop loss? Well, they put it above here. And what the price do? Well, price runs away with their stop loss. In triggering their stop loss, remember, if you're selling, your stop loss is a buy order. And if you're buying, your stop loss is a sell order. So they pick up your stop loss and take that as more liquidity to run price. Okay, so now let's explain let me clear the screen so we can see more. Now, the different phases of the Wyckoff schematics. Now, the accumulation phase. Now, as you can see, price is already bearish, right? So this is what this identified, that the market is coming down bearish. Now, you would see what is called a PS. Now, PS stands for preliminary support, right? This is the where price halts for the first, really halts for the first time. It will not, now you wouldn't notice this when it happens. You would notice it as the phase begins to proceed. right? So we have the preliminary support, and then we have SC. SC stands for selling climbers, right? So this is basically the end of the selling, the view actual where the trend is basically shifting. So the end of that trend. And then we have what we call an automatic rally, AR. Now, AR stands for automatic rally. Now, between the AR or between the SC and the AR, it develops the actual range, right? The range of the market. Now, price can go up a little bit above it or go down a little bit above it. It doesn't negate it truly, right? Now, let me clean back some of this again. Let's delete this, and delete this. Okay. Now, so basically, when the market gets forms, from the PS, which is preliminary supports, it makes an SC, does an AR, that's automatically. Now, then we have the secondary test. Now, this ST, which stands for secondary test, is basically going to be the end of the phase B, right? Of the phase A. So you can see there are several phases here. Now, don't worry, when we go to the charts, this will make sense. You'll see that this begins to make sense. Now, what basically is happening within this whole range is the composite man is accumulating orders. But how do you think they can accumulate these orders? They can only accumulate orders if you're selling to them, right? That means if your stop losses are triggered or they're trying to buy, they want to push price upward, but you're selling because you think price is still going downward. All of those things is how they accumulate orders. Now, once the composite man has showed his hand, right? Once the market has entered the oversold territory, gone from the selling climbers to the automatic rally, made the secondary test. This is where you start to see it will appear as though the market is now breaking higher. So remember, the market was making lower highs, right, and lower lows. Now you see the market would make an equal. It could be an equal low. It could be a higher low. So makes a higher low. They make a higher high. Basically, it appears as though the trend has changed, right? And if you think the trend has changed, you're not really wrong. However, this does not mean that price is now automatically going to start going up. What they need to do is accumulate as much order within this area by both buying and selling. A lot of the times, like most of the times, it's not your orders, your $1,000, your $10,000 account, and your one lot that you're trading cannot push price up or down. So it means that the composite man, even though he wants to buy, has to sell. So he has to sell to cause price to come down to get you interested in selling, and then buy to make price to go up to get you interested in buying. So within this ranging phase, or within this range phase, you'd see the market would just be basically choppy, right? Going up, down. And that's where you start to see what appears to be a ranging market. Now, this concept you would see even on a 1 minute time frame, on a 1 day time frame, on a 1 hour chart, and even on a monthly chart. You'd see this whole concept there. And then we enter the phase B, where the price comes down, make another secondary test, a secondary test in the phase B, and then still stays within the range. Now, after accumulating, so what happens here is a lot of accumulation. The smart money operator is accumulating buys, maybe buy 1 million lots, sell 900 lots, buy another 500 lots, sell 300 lots. So there's a lot of buy sales within here, confusing you as to what the market wants to do next. And then here's where the shakeout actually happens most times. You would see a situation where price makes, so you would see something that appears. This is what is called a spring. Those times where, well, this is a level of support. Somewhere else drawing. This yellow line is a level of support. Price comes down, ranges, and then breaks down below it. And everybody begins to think, oh, support is broken. Let us sell. And they start, and so they start selling as price goes up, right? Only for price to then continue to go up. And they're wondering, but how is it that price broke support, but it's not hold? and they keep wondering why their levels don't hold. So this is a spring where it's basically induces, it's more of inducement, induces retail traders to get involved in the opposite direction, and then they push price up. Now, this is not actually the area you start to look to get involved, because the whole, now you could have multiple springs as well. The whole idea is not yet done. Now, what you want to see next is a sign of strength, which will show the hands of the composite man. Remember, all within this period, price has been trading within a range, right? It could go higher or lower slightly, but actually within a range. Now, after accumulating enough position and potentially making a spring, now it's not all the time you see a spring, what you'd see would be the show of strength or the sign of strength. This is where you now start to look to get involved, because what it means is smart money operator has accumulated enough position, at least most likely, and then have shown the actual strength after shaking off the weak hands. And then what then happens is we look at this as an area to look for buying opportunity after price has broken out of this trend. Sometimes you could see a deep pullback to mitigate leftover order blocks here before price goes up. Okay, now I'm not going to explain, I'm not going to do this whole breakdown in explanation in each of the different schematics I'm going to show you, but you get the idea. Now, another way the accumulation schematic might look, this is still similar to that one. The only difference is that in this one, there is no spring, there's no shakeout. Here, the market went from phase A, went into phase B, accumulated position. There was no shakeout, there was no spring. The market just went on to show its hand, sign of strength, and then push up. So this is where we now start to look for buying opportunity here or buying opportunity in the last leftover order block. Now, I want to quickly go over so that we can look at some examples, because I think we'll spend too much time explaining. Let's look at what the distribution schematic would look like. Well, the distribution schematic would look something like this. So in this case, now for the accumulation, right, you can, for this, let me go back a little bit. For the accumulation schematics, the explanation I gave here was that, okay, where price has been bearish, right? That's not always the case. Sometimes it's reaccumulation. So for example, market has been bullish for a while, then ranged for a little bit before continuing bullish. You still see Wyckoff schematics there. It's also called reaccumulation. Now, okay, for the distribution schematic, price is in a push, right? Is in a push and gets into an overbought region. Now, this is not, when I say overbought region, I'm not referring to use your indicators and look at RSI or stochastic. No, that's what I'm talking about. I'm talking about the composite man believes price is actually overstretched. Not you believing, the composite man. Now, what you would see is they will start taking their profits, right? So they'll start taking their profits from the buys, right? And that would reduce the order or the volume of price movements in that particular instrument or at that particular time. And then you will now see price go into these same phases. So let me clean this. PSY stands for preliminary supply. That's just basically this is where the sellers or the buyers or composite man begin to take out most of their profits from all of these buys and want to probably take price the opposite direction. So they take some of their profits here, they allow price move up. BC stands for buying climax. So buying climax, this is basically the climax of buyers. And then we have an instant rejection, an automatic, which is why we call it an automatic rally. Now, the automatic rally, so we have the PSY, the BC, the automatic rally, and then we have a secondary test. So price push up. Remember, like I said, this could be equal or higher. It could be equal or slightly higher, but then we have the secondary test, and then again you see price begins to push down. Now this is where people get, for example, let me clean this. Let me clean most of this again. Now at this point, retail traders will be looking at this and saying, oh, there is a trend line here. You can see the market has changed structure. This is a high. This is a lower high. This is a low, right? This is a lower high, and then this is a lower low. So then they start looking to sell here. Now, because even though overall the price wants to go down, they're looking to sell here. Maybe they'll put their stop loss here or here, and they will be run out for losses because their liquidity, their sell orders would then be taken over grab all their stop losses, which UT stands for uptrust, right? The uptrust, basically, this is where it shakes out the first hands of people who are looking to get in selling very early. It shakes them out. And then price begins to range again. And then we have another UT, another uptrust, right? So this is UTAD stands for uptrust after distribution, right? So remember, this is distribution fees where the composite man is distributing, basically accumulating sell positions, right? Accumulating sell position, lots of sell orders, and then there's another, mostly you can see, we might see an uptrust after distribution, a test of that previous area, and then we have a show of weakness, right, or a sign of weakness, where price breaks below this whole range, right? Price breaks below it, show its hand, and then this is at this point, this is where we now start to look for, selling opportunity at previous order blocks or the last order block, right? You can see this is LPSY stands for last point of supply, last point of supply. So this is the area we begin to look for selling opportunity. Now, I know some of you, at least those of you who understand the concept of what I've been talking about here, we're saying, okay, that means that, well, if I get involved in a sell, I should not use stop loss, or I should put it very high. Well, that is not the answer, because just because it is appearing to be a Wyckoff schematic or it's appearing to be a distribution doesn't mean it is not a V accumulation. So what if you remember, a reaccumulation is, well, price is going up and then ranges, consolidates, and then continues going up, right? So what you want to do to give yourself the best shot is wait for the markets to go through the different phases. And when you've seen the sign of weakness or the sign of strength, that's when you look to get involved, either buying or selling. And then the second type of schematics is the same thing with the other one, but in this case, there's no UTAD, there's no uptrust after distribution. The price just begins to break down, shows the sign of weakness, and then proceeds to fall. Okay, now I'm sure some of you are like, what has this guy been talking about? Am I in a geography class or something of the nature? Well, let's take all of these concepts and go over to the market and see if we can make sense of what we dropped in explaining, okay? So we'll go and look at real chart examples and see how the concept of Wyckoff accumulation is used, or it's done, or how it can be seen, and how you can actually see the hands of the composite man. You can see the composite man's hand in what price is doing. And this concept applies in every single instrument, across every single time frame, and in every single market condition, okay? Until what you know becomes what you do, well, you would not make any improvement. It's something I always tend to say. Okay, so let's jump over to the chart and look at some real chart examples as regards what we've just been talking about for the past 45 minutes. Okay, so now we are over to the chart and we'll look at some live examples or some market examples, some real market examples, and how price went in, undergoes accumulation and distribution phase or schematics within structure. Now, take for instance, I'm just looking at this and I'm already seeing something here. So let's draw. So I'm going to just highlight this now. Let's look at this area, for instance, right? I'm going to make this. Let's call it consolidation. So let's color the box. I hope you can see this. Can you see this? Right? Can you see this? You should be able to see this clearly. Okay, so now here's the thing. This is a daily chart, right? You can see this phase here, or this area here, where price was consolidating, right? So where price is, you can see consolidating. Now, what did you notice here? Where does the composite man wants to take price? He wants to take price down, right? But what happened first? Now, think about it this way. I want you to think about it like a trader, right? I need you to look at what you probably would have been thinking when this happened. So let me use the replay bar in this instance. And let me do this, right? Now, within this region here, you can see that market is consolidating, right? The price is consolidating within this area, right? It's ranging since the consolidation phase. Now, most traders are looking at, oh, if price, this is resistance and this is what? Support. Well, if price breaks above resistance, well, price is going to want to come back here. And then if price breaks below support, price is going to want to come back here. Now, what does that mean? It means that if price breaks above here, if we have a candle that closes above here, what will happen? A lot of retail traders will be looking to get involved buying. They'll say, oh, the break has happened. They start buying, right? And then most likely they'll put their stop loss down here or maybe down here, right? Or maybe targeting this high or even probably higher highs. Because of the break, they said, oh, that's a break of not just break of structure, but break of a range. And then if you break that range, we're going up. Now, the composite man already knows where he wants to take price. He knows that, oh, he had a preliminary supply, our selling climax. Now, within this area itself, this would be, our own preliminary supply selling climax ST. Now, what happened is this. Let me clear all this, and let's continue with our chart. Well, price begins to move. Okay, so price begins to move. It went too fast. Broke above that area. What do you think a lot of people are doing? Well, they are looking for buy opportunity, right? So they're looking to buy. Some are looking to, they buy immediately, the breakouts happen, stop loss below here, right? Other people will look to buy, they'll probably draw their Fibonacci from low to high. Maybe they want to buy the 61.8 Fib level, stop loss below here. Whatever the case, people are looking to get involved buying, looking to target highs. Now, let me clear this so we can see more. What happens is, well, this is now our upthrust star distribution. So we had our upthrust, there was no upthrust here, we had an upthrust, and then what happened is price broke down, right? So now I understand that. Now, the book example, the example that I showed you in the chat or in the slides, was very perfect, meaning, if you'd see price make an okay, so let me draw this again. Let's say price has been bearish, would have a preliminary support, would have a selling climax, market will go up, make an automatic rally, right? And then we'll have our secondary test, then we have, this is the phase A, and then we enter into the phase B, we break down, we go up, we accumulate a bit, and then we show our hand by faking out people and then taking them down. Now, looking at what I just drew, now it looks very silly. Well, it's not always going to be, just the same thing about market structure. It's not always going to be the perfect example, but you can see the shakeout. So when you think of Wyckoff, think of weak to strong hand transfer. This here is where the weak hands were trapped, and then they were all transferred when, obviously, if you spot here, you're definitely taking a loss. It's how much loss you take. Some people would hold on to it, and some people would continue holding on to it. Oh, the price is going to stop here. And more than often, price will take them down, right? So weak to strong hand transfer is what the whole Wyckoff schematic is all about. Now I'm going to show you a live example of a trade I took yesterday after the and this doesn't have anything to do with the news, right? I'm going to show you an example of a trade I took on gold yesterday on a 1 minute time frame based on the Wyckoff, based on the weak to strong hand transfer of power or basically of price, right? Now you can see price continues to goes down and then keeps going down. Again, this whole area here is its own Wyckoff. So let me see if I can draw that. Now, this is the daily chart. So this whole movement is a lot of movement, right? That's there, that consolidation there, it is own Wyckoff schematics, right? Where price consolidated for a bit, broke down. Now look at that, this is where most people will get it wrong because, well, they'll be looking to get involved buying or selling just because they see candlestick formations or just because they see ranging market and break out of the break of this area. However, remember what Wyckoff was talking about. First thing is you want to identify what is the trend. How do you know the trend? Well, the trend is the area of the market with the biggest move in the shortest possible time. So for instance, we had this Okay, before this time, you can see the market was trending higher. We had a big push up, right? A slow retracement down. Another big push up, a consolidation, and then a big push up. Again, we had price come down here, consolidated for a bit. At this point, probably okay looking for a buy, but then price broke down. I'm going to just take out this. Okay, so we had this big push down. What then happened? We have a consolidation, and then we have another big push down. So the whole idea of Wyckoff is to try and look for opportunities to get involved in these big pushes, because that's where you're going to make the most money in the quickest possible time, right? And in this example, you can see we had a ranging consolidation. Now, one thing you can also do, one thing I usually tend to do. So for example, if I'm looking at an area where for a possible Wyckoff, for a possible accumulation or distribution, this here could be an accumulation or distribution based on, let's say, on a 1 hour time frame, right? So within, let's say, a 4 hour time frame, you would have seen a clear Wyckoff schematic here that you'd have been able to trade, because you're already looking for structural for price movement in the overall direction of price. And then we had another, this will be a distribution or a redistribution where price consolidated for a bit only to continue going down. And then let's see, let's continue to see what happens. You see price move from a strong range to a consolidation, to a strong range to a consolidation, and back and forth and back and forth. Again, look at what happened here, right? Notice that the market consolidated a bit here within this region here, where, you know, price would have gone through phases, right? And then shaked out the weak hands and then push price upward. Now, imagine what it would feel like for retail traders, day traders, looking at the 1 hour charts. This area here would have looked like a lot of big movements, like big candles or big candles down, and then they're looking at this, oh, the market is bearish. But then what happens is, well, price, you know, this candle, right, this bearish candle that looks like a pin bar, on a 1 hour chart would look like price is actually breaking down away from here, only for price to aggressively go back up. Why did it do that? Well, it grabbed all their orders here, all their sell orders, and then took it to use it as catalyst to push price upward. What you notice after the smart money operator has actually moved price is that you see aggressive movement in price in the other in the direction they actually want to move. You can see how aggressive this push was. For example, you can see how aggressive this push was, right? Now let's just as an example, let's go over to the current market and let me show you what I was talking about in terms of the trade opportunity I discussed or I talked about. Okay, so if we go down to, right, so I'm going to just explain the premise of the reason for the trade. Well, actually, the market has shifted from being bullish from being bearish to being bullish when we had this. First of all, I'm going to explain the both of them. So for example, first of all, there was a breakout of this trend line like so, right? You can see it. That's one. Second of all, you can see the structural shift. Price was making lower lows and lower highs and lower lows and lower highs and lower lows and lower highs and lower lows and lower highs. And then we undergo a consolidation here, and then price went on to make a higher high. You can see this is a higher high, right? So since making this higher high and since breaking out of this trend line, what it tells me is that right now the direction where price really wants to go is upward, because that's the direction of the direction of least resistance, right? And then you can see how price has been dragging itself up. Now, I'm not going to, there were several trades. I got into several buys from all of these areas, but I'm just going to talk about the one that happened yesterday. So if I drop down to, let me actually pull up the chart I used. Some of you who are, those of you who are clients who have funded your account, you would see that on the Telegram channel for funded clients, where I sometimes post signals, I gave a trade setup on gold, right? And yeah, this was my actual trade. I gave a trade setup on gold. I actually sent out this, right? I think it was on the 5-minute time frame. So it's lots of things here. There was this, you can see this bullish flag, price broke out of the bullish flag. This was before the FOMC news, right? So basically all I was looking for, I was watching for was an anticipation of price to continue to go up, right? This was my target. My target was 1948 points, that's 1948.40, right? Which was this high here, somewhere like here, 1948, right? Now, notice what happened. Okay, because there's too much things here, let me go back to the chart I was using so I can draw freely. Now, notice what happened here. The markets went from this, it did this push up, right? We had this aggressive push up, showing the actual, remember, your money and my money cannot cause this kind of movement. It has to be the composite man. And then after making this push up, price began to consolidate. You see, price wasn't really making any movement. It was just, you can see it, it was just ranging. It wasn't going anywhere. It was just ranging. Now, in some cases, you would find that the ranges will get it's just, in this case, it just kept ranging and the range began to expand a little bit. But let me just draw a box to cover it, right? So this would be the range, right? Now, notice what happened is, now this is a 5-minute chart. I showed you an example on the daily chart. Now this is a 5-minute chart. Actually, the actual example was even on, my actual trade was taken based on a 1-minute time frame. We consolidated. If you're a type of channel person, so you trade channels, you would see that there was a channel here. So we had to draw here now. There was a channel, something like so, within this area here, which price also consolidated in that same region. So I'm going to delete the channel, but you can see the channel I was talking about. Okay. Now, price wants to go up. At least I'm anticipating based on the overall structure of the market. You can see big push, consolidation, big push, right? Based on this whole structure of the market, I'm identifying this and saying price really wants to go up, but I need to wait for it to be ready to go up so that I can get involved. Imagine if I try to, and actually it's okay if, imagine if I try to sell here, or buy here like this, that would have been a loss. And that doesn't mean I'm wrong with the direction. It just means that the composite man is not yet ready to take price up, right? Now, in this instance, you can see how we came back, so price came down, faked out, right? We had this fake out here, or spring, right? Where, because price pushed back down like this, a lot of people would have seen this and started to sell, right? Oh, price wants to go down. And then what happens is price pushed back up. Now, the actual trade I took was based on the 1-minute time frame, right? Based on structure within this area, and I took that up. Now, let me see if I can explain that even further. So, yeah. So you can see this here, price began to push back down. So this is still within that phase, and then we broke higher, breaking structure, right? And then I looked for a pullback to the last order block within that region. And then, so I had my stop loss, something like, where is you? Yep, something like this, right? So I had a small trade, something like this. And then because it's gold, right, I actually had another trade because I know that sometimes when gold pushes, it doesn't pull back. I had a pending buy stop above the stop loss down here. So 2 trades, right? And that was all based on this understanding of Wyckoff accumulation and seeing the smart money, composite man's shakeouts, the weak hands by liquidating. So you can see liquidation to the top, liquidation to the bottom, and then we have price push up. So basically what you're looking for, what you're, you know that we're undergoing weak to strong hand transfer or Wyckoff schematic. If, for instance, let's say at the level of support, price comes down, push down, closes back up above that area, most likely you're going to see price go up. So you don't want to be in a hurry. So most times people see this break and they immediately start selling, not knowing that this is just an inducement to get you to start selling so that they can then grab your stop loss. So you've heard of those things called, manipulation. It's not manipulation in the sense that the broker is doing anything to use manipulation in the sense that this composite man is trying to take your orders, is trying to shake out your weak hands and take your trades as liquidity to then push price upward. Okay, now I think I'm going to stop here for today. We have talked about a lot in this particular class. Some of you, your head will be like, this is a lot to take in all in one go. But the concept is actually quite simple, right? If we have this, when you see the market consolidating, that's an area to watch for and see, okay, what is the structure of the market? What's the trend in the previous? What is the market really looking to do? And then once the composite man shows their hand, follow them and trade in the direction that they are looking to go, right? Don't be in a hurry to get into positions. This means that sometimes you miss trades, like you would not get into position because you're waiting and you don't get the confirmation you're looking for, but it's okay, right? Successful trading involves about 90% waiting and 10% executing, right? Now, based on this same movement, now let me give you a tip. So a closing remark. Now, remember that in the explanation of Wyckoff, we also said, I mentioned that after the market has consolidated, most times, when it breaks out of that range and actually shows hands, right? When price breaks out of its consolidation after shaking out the weak hands and maybe moves up, most times price tends to do something like this. It tends to come back to mitigate. Previous leftover order blocks. So price would come back down, capture the last set of order blocks before going back up. Now, in this case, what this means is, well, this whole push down could be coming back to mitigate this last order block here. And if we tap into that area, we could see another movement upward, right? So you could see maybe another 1 minute Wyckoff here. Might not necessarily be another Wyckoff. It could just be a tapping and a rejection. But I'm anticipating, so because of this breakout here now, my anticipation is that, is that we could see price come back into this area like so, right? So this area will be of interest to me. Why? Because I'm looking for buying opportunity. If price comes in here and taps into that area, I'll probably be looking for opportunity to buy. I'm not going to buy in. I'm not setting a pending order or anything, but I want price to get there. And then I'll look for confirmation and then I'll look to take price higher, right? So this is all based on the idea of Wyckoff schematics. Okay, so I think this is where I'll call it a wrap. I'm going to take your questions now, but I hope you get the idea. Remember, if you don't, you can always get access to the video once it's uploaded, and we watch it as many times as you need to understand the concept that I've been trying to explain for the past an hour plus. Okay, so I hope you enjoy the class. Let me know your feedbacks and I'll take your questions.